What I'll cover in this video is an overview of how corporations and small businesses use whole life insurance for deferred compensation plans and equity partner buyouts. So the first question that always comes up is, how are companies using whole life insurance? How is the whole life insurance product benefiting them, and what strategies are involved with it? I'll cover 4 of the more popular ones. First, we have succession planning. This is very common, especially with law firms and small businesses that have multiple owners or multiple equity partners. Next, it's used as a retention strategy, specifically to retain top talent or key employees, and then reward them on the back end if they've stayed with the company for a long time. Third, the life insurance benefits. Those are valuable both in the short term, and then also there's a very lucrative long-term benefit because life insurance is always paid out income tax-free. I'll talk about that more in detail. And then lastly, we've got the cash value, as the cash value is considered a safe asset on the balance sheet. It's very similar to BOLI, but when you look at the products used for small companies or small businesses, it is a bit different, but I'll go through the pros and cons of the cash value and exactly how it works. So, succession planning. Let's start with this. We'll use an example of a law firm. So let's assume that we see a law firm and there is a senior partner there that's about to retire. It's not uncommon for the firm to buy the equity back from that partner. So here's an example. Let's say a law firm is valued at $10 million. That partner has a 20% ownership stake in the company. 20% of 10 million is $2 million. And then at retirement, the company is going to buy that equity from the partner. So that's $2 million. It could be in the form of a lump sum if they just write a check for $2 million. However, it's usually spread over several years. For example, the retired partner might receive $200,000 per year for the next 10 years. So that's a common example of an equity buyback. However, there's often a problem with this. The problem is that this partner retires, but new partners come in. And new equity partners sometimes feel like they are paying for the retired partner's buyout, because they are. But the issue with this is as follows. Retired partners are paid from the firm's revenue. They're retired and they're not producing anything for the company anymore. Whereas new partners who are producing revenue for the company, they see money that would go to them because they own equity in the company, going to a former partner that they may have never even met. So this does cause problems with law firms and small businesses, and sometimes highly talented individuals consider leaving because they feel like they're giving money away to someone they haven't met and they don't like that setup. So whole life insurance is used as a solution or a possible solution. Here's how it works. With the whole life insurance product, we are prioritizing the cash value, and we're really looking at the cash value as a savings bucket. And then this savings bucket, this big old pile of cash, is used to pay the retired partners. So the cash value is used to compensate the retired partners instead of pulling it from future revenue, which reduces the stress on future cash flow and allows those new equity partners to truly feel vested. They get their full equity percentage, which results in them staying, which helps the company grow ultimately. So here's how we create this. What we're doing is really just creating a savings plan, a lot like a pension, but we're doing this with a whole life insurance product. We've got strong guarantees in the product, so we don't have to worry about any variables in the stock market or anything like that. And here's a key point, especially with small businesses and really anyone that says, I don't want to just put money away for retirement because I value the money for the business right now. We can use the cash value anytime. So if the 3 of us own a law firm together and we are funding an employee's future buyout, while we're funding it, we can use that cash value by loaning against it. The most important piece is just making sure that we repay that loan before it comes time to pay that retired partner. We want to make sure there's enough cash value to compensate them. But what this does is it prevents an owner from feeling like they're just socking money away for retirement. They can still use it to grow the business today. Not everyone does that, but just knowing that I can access it provides a lot of value and helps people pull the trigger to move forward too. Next, retaining top talent. So how this works: the company selects owners and employees who are going to participate in this plan. It is a non-qualified plan, meaning it's not qualified like a 401k, where if we offer it to one person, we have to offer it to everyone. It doesn't work like that, which is nice. So the company selects the people that will participate in it. The company sets vesting requirements that the employees must meet in order to receive a very lucrative financial benefit. Here's an example. The company says to the employee, if you stay with us for 10 years, you're vested. What that means is you're going to receive a deferred compensation package that could be a lump sum of $1 million, or maybe it's $50,000 per year for the next 20 years. The company sets the terms and structures it however it wants. But what the company is doing is saying to the employee, if you stay with us, you get this. That's how they're retaining them. I'll talk about that a little bit more right now. Think of your top employees. Of all of those top employees, who would you say is the most valuable employee? They're a hard worker, loyal, an absolute superstar. They're always coming through, even at the worst times. And then here's my favorite, they don't complain. How would you feel if that person left your company? Probably like this. So this is a real thing, especially with smaller businesses. How do companies prevent this? Deferred compensation packages is one way. All we're doing is saying, I'm going to give you money in the future. However, you need to meet certain terms. So let's take that superstar employee. You want them to stay with the company. You're going to offer them a deferred compensation package, but the terms are as follows. They need to stay with the company for the vesting period. You set the vesting period, let's say it's 10 years. So if they stay with you for 10 years, they're going to get that retirement benefit. So they stay with you for 10 years, they get a benefit of $1 million at age 65, and you might say, we're going to pay that to you over 7 years. This way you're not taking a full $1 million withdrawal up front. You can, but usually it's spread out. Now, what if the company leaves before that vesting period? Before the 10-year vesting period, that is. They get nothing, and the company keeps the cash value. Even though the life insurance policy is on that employee, they leave the company still keeps it. So pretend that you're the employee. If you were told, if you stay with us for 10 years, I'm going to give you an extra $1 million when you retire. That's on top of your 401k plan, all of your investments that you have. This is me giving you another $1 million. Would you stay? Most people probably would, especially if they enjoy working with you, if they like working for the company, that is. So this is referred to as golden handcuffs. I'm handcuffed to the company. However, when the handcuffs are unlocked, I get to keep them, and I find out they're worth millions. So this is referred to as a non-qualified deferred compensation plan. And this is a formal plan with a legal agreement. And here's how it works. The company owns the policy. The company offers the employee this deferred compensation package. The company sets the vesting requirements for the employee. The company is writing the check. They contribute to the plan. Plan contributions are generally not tax deductible with these. However, the company can access the cash value tax-free anytime they'd like. There's no penalties or anything like that. Now, the company does promise to pay the employee a retirement benefit, but that retirement benefit comes from the policy cash value. When the company takes that cash value from the policy, they do not pay any tax, but when they give that money to the employee does pay tax on the benefit. That's a high-level overview of how it works. Okay, life insurance. What are some of the benefits, specifically to companies? There's a handful. Here they are. First, you get immediate key man insurance on any employees that you put the product on, that you get the life insurance policy for. It can also be used as a buy-sell agreement. This is common with small businesses. Here's a big one, cost recovery, which is the case with BOLI. This is like one of the big selling points with BOLI, where the life insurance proceeds, the death benefit that is used to recover costs that are associated with employees. That could be health insurance premiums, 401k matches, maybe it's deferred compensation plan contributions, could be anything. That death benefit does have value as it grows over time and it flows back to the bank 100% income tax free. Could also just use the life insurance proceeds to build cash reserves, because when they are paid to the beneficiary, which in most cases is the company, they're paid income tax free. All right, the cash value, safe asset on the balance sheet. We're talking about whole life insurance specifically here. So a quick overview of whole life insurance. We've got three colors, blue, red, and green. Starting with blue, that's the death benefit. We'll typically see the death benefit gradually increase over time. And when the insured dies, the life insurance benefit is paid 100% income tax free to your beneficiaries. Next, we have premium and PUA rider. PUA stands for paid up additions. This is how we maximize the cash value. I'm going to show you a chart in a little bit, but both of these terms are simply how we pay money into the product. The key on this is shrinking that premium as much as we can. That's how you beef up the cash value. Again, I'll show you that in a little bit. But then we've got the cash value. So the cash value is what is appealing to companies, individuals, everyone, because there's no risk, I've got guaranteed growth, and I can access it tax-free anytime. Just to reiterate those points, the cash value, there's no risk. It only goes up in value. I can access it anytime without penalty, and when I access it, I keep earning interest on it. Just like borrowing against a piece of property, assuming the fair market value always goes up. I still get the appreciation on the entire property, even though I have a loan against the property. Then if I follow IRS rules, which is really on the agent to do this, it's tax-free. So some benefits of the cash value. I've got guaranteed growth without market risk. I've got inflation protection. So dividend rates tend to adjust with interest rates. Here's an example. Guardian, one of the major mutual companies. We see their dividend rate for 2024 is 5.9%. Next, we've got Mass Mutual, 6.1% for their 2024 dividend rate. Cash value can be accessed tax-free, and it keeps on compounding if I take a loan against it. And then lastly, the death benefit is paid 100% income tax-free, and it's typically paid to the company. The company is the beneficiary. So how do these plans work for companies? Like if I'm speaking with a company as a referral, like how does this actually work? You might have conversations with folks on this. It comes up a lot once we know what to say. There's three main things to be aware of. We've got the corporation, the executive, and the life insurance policy. And the executive could be the employee, if you want to simplify it. Let's start with the company. Company pays for the policy. The policy builds cash value, and eventually they're going to pay the executive down the road with that cash value. Then we've got the life insurance policy. Cash value is an asset on the company's balance sheet. cash value is used to pay the executive. And the death benefit, that's money that comes to who later? The company, completely tax-free or completely income tax-free. And then we have Executive Tom. Executive Tom gets that retirement benefit while he's alive. The death benefit is paid at death. When he dies, life insurance is paid out. But the company receives that death benefit 100% income tax-free. Okay, we're going to wrap up with a sample plan. We're going to look at an executive for a 50-year-old individual, and this is actually based on a law firm that we recently put this together for. So the company is going to fund a $2 million compensation plan for this partner. He is one of the senior partners. This is a large law firm. And what that means, that they're going to fund a $2 million compensation plan. He gets $2 million when he retires, and his plan is to retire in about 10 years at age 60. So you can pay into a policy for a short period of time or a long period of time. If you take BOLI, it's one big lump sum. Usually we can't do that with traditional products, but companies that have cash on hand and want to copy that will do something like this, where they fund it for perhaps 5 years. So here, a lot of money is going in. The minimum, however, is $35,000 per year. That's your premium. Remember that other term, PUA? I like to call that a cash dump in. So they're paying in a total of $350,000 per year, but the minimum is $35,000, and the rest is going toward PUAs, which really grows the cash value of the policy. The break-even point is the 4th year, because they've paid a total of $1.4 million, and they have more than $1.4 million. At age 60, the cash value is worth about $2.3 million. Partner buyout. It's time to pay. So they started the plan when he was 50 years old. Year 10, he's 59. Year 11, he's 60. And here's what we've got going on. Total income, $285,000 per year. Over 7 years, comes at the $2 million. Now, the 7th year, he received about $290,000. We just kicked it up to last year. But that's the total income he received. Here's the cash value. When the income is coming from the policy, we see the cash value go down. We also see that the death benefit's reduced. So we distributed the $1.775 million we paid in. So we paid $350,000 for 5 years. That's $1.75 million plus another $250,000. So they got a total of $2 million. That's less than what they paid in. And then what do we see down here? The death benefit at 85 is still more than $1.5 million. So they got all of the money back they paid in and more on top of it. They still have cash value, and there's a big death benefit that's paid to the company when he eventually passes. I know that's a lot of information. What I will say is that these plans can always be customized, as every business is unique.